You know, in the crypto space, you get these projects that just split the room. And Yei Finance, with its token CLO, is definitely one of them. Is it a solid, fundamental piece of a brand new ecosystem? Or is it just a house of cards, waiting for a breeze? People are on completely opposite sides of this, and today we're going to dig into the data and figure out why. So let's just get right to it. This is the question, right? Rocket ship or time bomb? You've got some analysts who are super bullish, seeing nothing but blue skies ahead. And then on the other side, you have traders pointing to what they call massive, glaring red flags. So which one is it? Let's break it all down. Okay, so before we jump into the good and the bad, what does Yei Finance actually do? Well, its whole mission is to fix this huge headache in DeFi called fragmented liquidity. Just imagine your money is stuck in 5 different banks, and none of them will talk to each other. It's a mess, right? It's super inefficient. Yei wants to be the one-stop shop on the Sei Network, a single place where you can lend, swap, and move your assets around. Easy as that. All right, let's kick things off with the optimists, the bull case. Why do so many people think Yei Finance is on its way to becoming a DeFi powerhouse? Well, the arguments are actually pretty strong, and they're all about fundamentals and where it sits in the market. I love this quote because it really gets to the heart of the bull argument. It frames Yei as, well, not one of those flashy, hype-of-the-week projects. The people who are optimistic about it see a team that's just quietly building something that works. Real utility, a solid foundation, not just chasing trends. And look, that's not just talk. It's backed by some serious security credentials. Yei Finance has been put through the ringer by a bunch of different auditors, including PeckShield, who are, a really big deal in this space. And the results? They came back clean. No critical or high-severity problems. For investors, that's a huge green flag, a big stamp of reliability. And this is where things get really interesting. Yei isn't some small side project. It's a beast. It controls about a quarter of all the money locked in the entire Sei DeFi ecosystem. Think about that. And this isn't just people speculating. A recent 40 to 50% price jump was directly linked to people actually using the platform, with trading volume just exploding. Those are powerful signals that this thing is getting real adoption. And if you want to see how this team handles pressure, just look at this timeline. Back in late 2025, when the whole market was in crisis, they didn't panic. They paused things proactively. Then they dealt with a massive $8.6 million hole and made sure every single user got their money back. To survive something like that and then turn around and lead a rally a few months later, wow, that builds an incredible amount of trust. Okay, so the bull case sounds solid, right? Well, hold on. Because now we need to flip the coin and talk about the bear case. And honestly, despite all those strengths, there are some major red flags that have a lot of people seriously worried. You have to see this. All right, get ready for this number because, wow, this is probably the biggest single worry for anyone looking at this project. A mind-blowing 87.59% of the entire CLO token supply is sitting in one single wallet. Just let that sink in for a second. And here's why that number is so terrifying. It means all the power is in one place. It doesn't matter how great the tech is or how much money it's making. If one person or one group decides to sell, they could single-handedly crater the price for everybody else. Now, to be fair, this doesn't have to be a bad guy. It could be a founder's wallet, maybe some VC funds that just haven't been dished out yet. Who knows? But that uncertainty, that's the problem. It's a giant question mark hanging over everything. And this slide right here, this is the investor's dilemma in a nutshell. On the left, you've got those clean security audits we talked about. Looks great, right? Secure, reliable. But then on the right, you have a formal risk analysis from Zark.ai that is basically screaming danger, a warning alert, a 20% chance of a crash, and a grade of F. I mean, how can both of these things be true at the same time? It's the perfect picture of the conflicting signals investors are trying to figure out. And the worries don't stop there. First up, adoption. Yeah, it controls a lot of money, but the number of people actually using it every day is tiny, like 80 to 90 people. Then you've got thin liquidity, which is just a fancy way of saying the market is fragile. Even a small sale can send the price tumbling. And finally, let's be real, the project is still new. The tech just hasn't been through a long, brutal bear market to prove it can last. All right, so we've heard the hype from the bulls and the doom and gloom from the bears. How do we cut through all that noise? Well, we look at the cold, hard, on-chain data. The facts that are recorded on the blockchain itself, the stuff that you just can't argue with. Let's see what the numbers actually say. First things first, what's the whole thing worth right now? As of April 2026, the market cap for Yei Finance is sitting at just over $15.5 million. This gives us a solid, real-world number for how big the protocol is today. Okay, so it has a decent market cap, but is it actually making any money? The answer is a big yes. It's pulling in over $263,000 a year for its treasury just from fees on the platform. So this is a really key point. This isn't just an idea on a white paper. It's a real functioning business that's generating income. That's a huge point for the bulls. So, where were all these tokens supposed to go in the first place? Well, this was the plan. You can see the biggest chunks, 65% combined, were set aside for the community and for user rewards. That usually looks really healthy. But here's the kicker. That was the plan. The reality is that big, scary 87% number we saw earlier. The distribution clearly didn't go the way it was drawn up on paper. So we've dug through the tech, the arguments, the fear, the data, and where are we? We're right back where we started, smack in the middle of this investor's dilemma. It really is like a massive tug-of-war, isn't it? On one side, you have all this incredible opportunity, a dominant player on its network, clean audits, real revenue, and big plans for the future. But then, pulling just as hard on the other side, you have these massive risks. That insane token concentration, a formal risk warning from an analyst, barely any users, and a fragile market. It's a perfect storm of reasons to be both excited and terrified. And that leaves us with the million-dollar question, doesn't it? Are the fundamentals, the tech, the revenue, the market position, are they going to be strong enough to power through that massive shadow being cast by that one single wallet? Well, that's the dilemma. And that's a question only the market can answer.